This is the lecture on Chapter 1 in the Jeter textbook, which is an introduction to business combinations. A business combination occurs when the operations of two or more companies are brought under common control. A business combination can be described as either friendly or unfriendly, sometimes described as hostile. In a friendly combination, the board of directors of the potential combining companies get together and negotiate mutually agreeable terms for the proposed combination. The proposal then submitted to the shareholders of the companies that are involved in the merger for approval. In an unfriendly or hostile combination, the board of directors for the company that is targeted for acquisition resists the combination. And the targets in this unfriendly combination can resist in a number of ways. First, through a poison pill. A poison pill is simply a strategic maneuver in which the target company issues stock rights to existing shareholders that allow them to purchase additional shares of stock at a price below the market value, but they can only do this in the event of a potential takeover. It has the effect of making the company's stock less attractive to potential buyers, and it encourages those buyers to solicit offerings through the company's board of directors. The second defensive technique is greenmail. Greenmail is the purchase of any shares that are held by the would-be acquiring company at a price substantially in excess of their fair market value. And those purchased shares are then held either as treasury stock or are retired. A white knight defense consists of encouraging a third firm that is more acceptable to the target company management to acquire or merge with the target company. A Pac-Man defense is simply the target company reversing the roles and attempting an unfriendly takeover of the would-be acquiring company. The selling the crown jewels defense involves selling valuable assets to others in order to make the target firm less attractive to the would-be acquirer. Of course, the downside of this is if the target firm is successful and survives intact and is not taken over, it's left without some or a lot of its important assets. And finally, a leveraged buyout is simply the purchase of a controlling interest in the target firm by its managers and by third-party investors who usually incur a lot of debt in the process, and once having acquired all this equity, they take the firm private. The bonds that are issued in connection with a leveraged buyout oftentimes have a high rate of interest and are called junk bonds. So there are a number of pros and cons of engaging in business combination. In terms of advantages, one of the big claimed advantage of a business combination is operating synergies, achieving operating synergies, which can take a variety of forms. In the case of a vertical merger, which is a merger between a supplier and a customer, synergies can result from the elimination of costs related to negotiation, bargaining, and coordinating between the supplier and the customers. In the case of a horizontal merger, which is a merger between competitors or competing firms, synergies can arise from combining their sales forces, facilities, outlets, in other words, eliminating unnecessary duplication and cost. Another advantage of a business combination is it allows the firm potentially to gain a foothold in international markets. Tax savings also are an advantage of mergers. The tax code allows firms the opportunity to file consolidated tax returns, which may allow profitable corporations' tax liability to be reduced by losses incurred by unprofitable affiliates. And the last advantage that I want to mention here in connection with business combinations is diversification. Diversification can result from increased flexibility in internal capital market, and increase in the firm's debt capacity, more protection from competitors over proprietary information, and sometimes more effective utilization of the organization's resources. So those are the four advantages of business combinations. Some of the disadvantages, I want to mention three. First is pyramiding. If a company has an overriding emphasis on rapid growth to be achieved through business combinations, what might result is the pyramiding of one company on another without really having good management control over the resulting conglomerate. In other words, you have really sort of an unwieldy structure that cannot be effectively managed. Excessive debt is another disadvantage of a business combination. So in order to avoid significant dilutions of equity, companies involved in a merger sometimes rely on various debt and preferred stock instruments to finance the expansion, and find themselves unable to provide the required debt service during downturns in the economy. And so the junk bond market that was used to finance many of the mergers in the 1980s had essentially collapsed by the end of the decade because of the excessive debt associated with business combinations. And the last disadvantage is value destruction. Sometimes business combinations, rather than creating operating synergies, may destroy rather than create value. So now let's take a look at business combinations over time. There's a series of times that are periods that are discussed in your textbook that I want to mention here. First is the period 1880 through 1904. During this period of time, huge holding companies, known then as trusts, were created by investment bankers that were attempting to establish monopoly control in certain industries. This type of combination was called horizontal integration because it involves the combination of companies within the same industry. During the period 1905 through 1930, business combinations in this period of time were fostered by the federal government during World War II in order to obtain greater standardization of materials and parts and to discourage price competition. This was part of the government's strategy to fighting World War I. But after the war, these combinations were efforts to obtain better integration of operations, reduce costs, and improve competitive position, rather than attempting to establish monopoly control over an industry, such as what happened in 1880 through 1904. Basically, this was the period of vertical integration because it involved the combination of a company with its suppliers or customers. The period 1950 through 1979 was the period of conglomerate mergers. The primary motivation for these mergers was to diversify business risk. As an example, a company that operates in a cyclical industry might merge with a company that operates in a pro-cyclical industry, and as a result, the volatility of the underlying cash flows of the combined entity are lower than the volatility of the individual companies because they operate in different aspects of the business cycle, and the combination has the effect of dampening out the volatility of the combined entity's cash flows. During the period of the 1980s, we had relaxation of antitrust enforcement by the Reagan administration and the rise of the junk bond market together that fueled mergers fairly significantly during that period of time. And then we have the period 1990s to the present, where the mergers were fueled by pretty high stock valuations and continuing deregulation on the part of the government. So now let's talk about some terminology and discuss types of combinations. From an accounting perspective, which of course is our principal perspective here, the distinction that's most important for us right now is the distinction between an asset acquisition and a stock acquisition. An asset acquisition involves the purchase of all the acquired company's net assets. You actually buy their assets. Whereas a stock acquisition involves the purchase of the stock of the target company. So the distinction is whether you're buying assets or whether you're buying stock of the target company. A statutory merger results when one company acquires all the net assets of another company through an exchange of stock, payment of cash, or other property, or the issuance of debt instruments, or maybe a combination of these methods. So what you have is company A plus company B becomes company A. Company B goes away. In a statutory consolidation, a new corporation is formed to acquire two or more corporations through an exchange of voting stock amongst the shareholders. So in statutory consolidation, A company plus B company becomes a new entity, C company. The key idea here is that A company shareholders surrender their stock to C company and receive back C company stock. B company shareholders surrender their stock to C company and receive back C company stock. So two companies have decided to merge. The next issue that has to be addressed is to determine the acquisition price or the offering price. Determining this offer price requires the valuation of the target company's net assets as well as their expected contribution to the future earnings of the new entity. And of course, the valuation of assets sometimes will be done by accountants, many times will be done by outside appraisal firms. The forecasting of future earnings, contribution to future earnings of the target to the new entity, oftentimes that will involve a role for the accountant as well. The offering price normally consists of a value that is a component that is paid for the net assets of the firm and a component that is paid for the future excess earnings of the firm. And the future excess earnings of the firm is sometimes described as goodwill. And so estimating the value of goodwill to be included in in the offering price is very subjective. There's a number of different methods that you can use, such as discounting expected future cash flows, discounting earnings, discounting excess earnings, and the approach that we're going to emphasize in Chapter 1 is the discounting of excess earnings. This is to identify a normal rate of return on assets for firms that are similar to the firm that's being targeted. In the second step, you apply the rate of return that you identified in Step 1 to the level of net assets of the target firm to come up with an approximation of what a normal firm in this industry might generate in terms of earnings with that level of resources. We're going to call that product normal earnings. The next thing we're going to do in step 3 is we're going to estimate the expected future earnings to be generated by the target. And in step 4, we're going to subtract the normal earnings that we calculated in step 2 from the expected target earnings in step 3. And that difference we're going to describe as excess earnings. In step 5, we're going to capitalize those excess earnings through a discounting process. It's important to note that because the assumptions that are needed to implement step 5, discount rates, for example, discounting period, for example, you can obtain a range of goodwill estimates simply by varying the assumptions about the discount rate or the discount period. So step 5 is sort of the soft spot in the process, if you will. And then in step 6, we're going to determine the offering price by adding the goodwill we calculated in step 5 to the fair value of the firm's identifiable assets. Another issue discussed in the chapter is a discussion of the alternative conceptual views of consolidated financial statements. The chapter talks about how those two alternative conceptual views of the consolidated financial statements are the parent company view or the economic unit view, also described as the economic entity view. We're going to briefly discuss these. Admittedly, it's going to be tough for you to really have something to hang your hat on in terms of the discussion because you haven't seen yet the issues that are being discussed, but this is just sort of an overview. Under the parent company concept, this particular concept emphasizes the interest of the parent's shareholders. As a result, the consolidated financial statements reflect the stockholder interest of the parent itself plus their undivided interest in the net assets of the parent company's subsidiaries. Under the economic unit concept, this particular concept emphasizes control of the whole entity by a single management. As a consequence, consolidated financial statements are intended to provide information about a group of legal entities, the parent company and its subsidiaries operating as a single unit. The economic unit concept is the concept that the FASB has adopted and is embedded in current GAAP for the preparation of consolidated financial statements. So there's a series of financial reporting impacts that arise from the different conceptual views that you might adopt, parent company versus economic unit view or economic entity view. The first involves how the non-controlling interest in the equity of the balance sheet is reported. Under the economic entity concept, the non-controlling interest is a part of the ownership equity of the entire economic unit. Whereas under the parent company concept, this non-controlling interest equity is sort of ambiguous. Is it a liability? Is it equity? And so historically companies sort of reported it as part of liabilities even though it's not conceptually a liability according to the definition of liabilities in our conceptual framework. So this issue involves how do you report the portion of the equity of the subsidiary that belongs to the non-controlling interest, outside parties. Another issue involves reporting the non-controlling interest in the income generated by the sub. Is this non-controlling interest claim on the earnings of the sub, is this an expense of the sub in the consolidated financial statements, or is this considered to be an allocation of consolidated income? If you view it as an expense item in determining consolidated net income, you're adopting the parent company view. If you view that as simply an allocation of consolidated net income, you're adopting the economic entity or economic unit view. Another issue is how the sub's assets are reported in the consolidated financial statements. If the assets are appreciated and the purchase price reflected that appreciation, do you reflect in the consolidated financial statements only the portion of the appreciation purchased by the parent company, or you report all of the appreciation? If you say that you only reflect the portion of the appreciation purchased by the parent company, then you're adopting a parent company concept. If you say that you're reporting the full value of the asset in the balance sheet, you're adopting an economic unit or economic entity concept. And the last issue is elimination of unrealized intercompany profits. If you take the view that you're going to eliminate the entire amount of intercompany profit, you're adopting the economic unit concept. But if you take the view that you're only going to eliminate the portion of the profit that is attributable to the ownership percentage of the parent, then you're adopting the parent company view. I know this discussion of parent company versus economic unit probably is less than fully clear to you, because again, it requires that you have some degree of understanding of the mechanics of how consolidated financial statements take place. The key takeaway for you here is to recognize that there are the two concepts, the parent company view versus the economic view, the economic unit or economic entity view, that the FASB has adopted the economic unit or economic entity view, and that the view that you take has an impact on how you report things in the balance sheet and the income statement of the consolidated financial statements.